Let's suppose that we want to generate a certain level of profitability, and in this example it's $11,250 for the month, and we want to ask the question, we want to figure out how much sales revenue does that represent? How many dollars of sales revenue do we have to generate in order to achieve that profit? Well, your general formula is going to be this here. So sales revenue in terms of dollars is going to be your fixed costs or your fixed expenses plus the target profit, and we're going to divide all of that by our contribution margin ratio. Now in this case, the contribution margin ratio is given to us as 75%. What that means is that for every dollar of sales revenue, this company generates 75 cents of contribution margin. So the fixed expense that we're trying to cover is $585,000. The target profit is $11,250, and we're going to divide that all by the contribution margin ratio. So we've got a total contribution margin that we need to generate just under $600,000 here, $596,250. And let's see what that looks like in terms of sales dollars, $795,000. So as we take a step back and look at what we did here, we're basically saying for every dollar of sales revenue we earn 75 cents of contribution. We need to earn enough contribution margin to cover our fixed expenses, and then on top of that to generate this profit right here. So we need this much contribution margin in total. And in order to do that, we need to generate this much sales revenue. If we want to double check ourselves, we can easily do that. Let's just take that sales revenue that we just computed right here, and let's multiply it times our contribution margin ratio. If we've done the math correctly, this should equal the contribution margin that we need in total. And if we take a look, $596,250. Working backwards, we were able to demonstrate that we do have, we didn't make a mathematical error or anything like that. Now, one thing I'd like to point out is that it seems like with cost volume profit analysis there are a lot of formulas to remember. But I would argue that there really are two that you need to remember. One would be the formula we have right here. If you need to figure out sales revenue for a specific target profit, you simply take your fixed cost and your target profit, divide by your contribution margin ratio. Now, what if the question is asking for a break-even point in terms of dollars? If that's the case, you just eliminate the target profit and you set it as 0. The break-even point is really just a specific level of target profit. It's not a very ambitious target, it's a target of 0. So this formula right here is one of the two. The other is the target profit formula for unit sales, and that simply is the same numerator but dividing by contribution margin per unit. So if you can memorize the target profit formulas for sales revenue and for number of units that we need to sell, you can use both of those formulas to answer questions regarding both target profit and break-even point.